Today we're going to talk about the accounting equation, assets equals liabilities plus owner's equity. So let's first define these terms. So what is an asset? Well, an asset is something that the company owns or that they have the right to receive. So some examples of assets would be the building, the land, the equipment, the inventory that the company uses in their operations or that they're holding for future investment. They also may have the right to receive something. For example, an accounts receivable is an account where a customer purchases some inventory on account, meaning that they are going to pay for that inventory later. And so the company has the right to receive payment for that sale in the future. So accounts receivable would also be included as an asset. What about liabilities? Liabilities are the obligations of the company, things that they owe to somebody else. These are the creditor's claims on the assets. So, for example, if a company goes to a bank and borrows money and they plan to use that money to purchase a building, well, that increases their assets, it increases the building that they have, but it also would increase their liabilities, the amount that they owe to someone else, the bank. So the creditor, in this case, the bank, would have the right, if the company didn't pay them back for the loan that they took out, would have the right to go and to foreclose on the building and sell the building and receive payment that the company owed them. So the creditor would have a claim on the assets, or in other words, the right to go and to take the assets to receive payment. So these are the obligations of the company. The obligations, by the way, might also come in the form of responsibility to perform some service. For example, if a company received payment from a customer in return for the promise to perform a service in the future, at the time that they receive that payment, they're also going to record a liability because they have an obligation to go and perform that service for that customer in the future. The third one here is owner's equity. So what is owner's equity? It's the owner's claims on the assets, the owner of the company. For corporations, the owners are shareholders. The company sells shares of stock to individuals or to other companies. They receive cash in exchange for ownership. So if I'm a stockholder in the company, that means I'm a part owner of that company. And the way that the company benefits is that when I purchase that share of stock directly from them, they receive cash that they can then use to purchase their assets. So capital stock is one of the accounts under owner's equity. We also have another component of owner's equity, and that is retained earnings. Retained earnings come from a company who is in the business of making a profit. They go and they sell their inventory or provide the service that they're in business to provide. And after paying all of their expenses, they'll have some profit, hopefully. That profit, if they keep that within the business, is what we call retained earnings. So it's the portion of the profit that they keep within the business and don't distribute back to the owners or the shareholders of the company. So let's step back just a little bit and look at the equation overall. So we have assets equals liabilities plus owner's equity. In other words, the total amount that we've recorded as assets have to equal the sum of the liabilities and the owner's equity. Another way to think about this is that the assets, being the things that we have, that we own, had to be paid for in some way. We either had to borrow the money from a lender of some type, those would be the liabilities, or we had to sell shares of ownerships and have people contribute money to the business in exchange for ownership in the company. That would be the capital stock component of owner's equity. or we had to earn that money. We had to borrow it, we had to have it contributed to us in exchange for ownership, or we had to earn it, which would be the retained earnings portion of owner's equity. So the sum of our assets has to equal the sum of the ways that we purchase those assets, those three ways we just talked about. Another way to look at owner's equity being the owner's claim on the assets is to take assets minus liabilities equals owner's equity. So in other words, whatever assets you have after you subtract out all of your liabilities, all of your obligations, what's left over for the owners to be distributed to them if the company were to be liquidated. So this is the accounting equation, or at least an introduction to the accounting equation: assets equals liabilities plus owner's equity.